Okay, David, from your perspective and the RBC's perspective, what's your outlook right now for the Canadian dollar?
Well, it's still pretty positive, but not excessively so. We do see the Canadian dollar rallying towards 105 in mid-year and then beginning to tail off a bit as we see the U.S. dollar beginning to come back. But I would say from my perspective, the risks as they lay out right now look like we'll get more Canadian dollar strength than we anticipated rather than say, more CAD weakness. So
what's pushing this? Is it a petrocurrency, or is it just the fact that the U.S. dollar is so weak?
A bit of both. I wouldn't even necessarily say it's just petrocurrency. I would say the global economy looks relatively healthy. Commodities look relatively healthy despite a pullback that we've seen this week. And as a result of that, you get those two factors which are helping the oil story and raw commodity story. And then in the backdrop, you've got that U.S. dollar story, and the U.S. dollar is just not been doing very well over the past several weeks, and it's hard to build scenarios to see where it could start to rebound. Now, hopefully, maybe that's a situation where, since it's hard to build a story to see the upside, that's the time that we will see a rollover because everybody's imbalanced towards further U.S. dollar weakness. But you look at the U.S. situation, and it's really hard to build a case for a sharp rebound in the U.S. dollar anytime soon.
So what's the Bank of Canada's position on this? Obviously, as exporters, many of us in agriculture are somewhat concerned by this high dollar. Do you see the Bank of Canada taking a position to kind of try to harness this a little bit?
Well, yes and no. They certainly and clearly expressed discomfort with the Canadian dollar this morning when they released their NPR. They had their great decision yesterday, and they alluded to this, but they provided more clarity this morning. Clearly, they are concerned about the Canadian dollar strength. They're concerned about the commodity upswing, which, while good for Canada, unfortunately is largely an EM or an emerging market or a China story. And we don't really export all that much of our natural resources to China. Most of it goes to the United States, especially when you think about the oil market. Almost all of our oil, and for that matter, all of our natural gas, goes to the United States. So the commodity upswing that's being driven by the emerging world that basically is leaving the U.S. behind isn't a great situation for Canada. And we have already got a currency, as many of your listeners probably know, that is uncompetitive. So the Bank of Canada is clearly extremely concerned about that. And I think that's one of the key reasons why they are reticent to start raising interest rates again. The other scenario that the bank laid out was clearly a situation where the domestic side of the Canadian economy likely needs higher interest rates sooner rather than later. But the Canadian dollar strength just suggests that they have patience and they're going to use that flexibility afforded by the Canadian dollar because they don't want to increase the competitive burden of exporters.
So how long do you think they can hold back from raising rates?
Well, we have them going in July and pretty rapidly after that. But again, by that time, we expect the Fed quantitative easing programs are there to be finished. So the Fed will be starting to talk about exit strategies. And hopefully by that point, we'll start to see a bit of a rebound in the U.S. dollar. But if we don't, and the Canadian dollar continues to strengthen as it has over the past few weeks, as opposed to the performance over the past few days, the Bank of Canada could indicate that the rate hike campaign could be somewhat slower than we've anticipated.
So is there anything out there that leads you to believe the U.S. dollar is going to start to rebound? Like, what is the case for that scenario?
Well, you've got a couple of things that are unfolding. Most of them come around mid-year, and that's when we sort of expect the U.S. dollar to bottom out and begin to rise. One is the debate that's going on now over the fiscal situation, and not the debate over whether the government's going to shut down or not. It's the debate on the debt limit. And if they increase the debt limit debate, that would ease a lot of the concerns in the short term. There's a lot of concerns now that when the debt limit is hit, which could happen on May 16th, if they don't raise the debt limit by July 8th, the U.S. might have to go into technical default. And that's a big issue for global financial markets. So, when you think about how widespread U.S. Treasury holdings are, if the U.S. goes into a technical default, that's not a good scenario. The Treasury Secretary is clearly alarmed at the possibility of that occurrence. So if we get through that debate, increase the debt limit without necessarily having to talk about the U.S. potentially going into a technical default, that'll be one thing which will lift a burden off the U.S. dollar. Once the Fed finishes quantitative easing, and once Fed Chairman Bernanke starts to talk about exit strategies and potential rate hikes in the U.S., that will be another burden lifted from the U.S. dollar. And you look at the U.S. economic performance outside of housing, especially in manufacturing, it's quite good. So there is a case to be built that once these two hurdles are out of the way, that the U.S. dollar could see some material upside. But again, the risks are certainly there that it could see some downside before we get to that point.
I think for many of us in Canada, when we look at the U.S. economy, the first thing we talk about is housing. Is housing, obviously it's still not doing well, especially in places like California, Arizona, and Florida. Is housing a lag indicator?
It's hard to say right now because the market is so impaired that it's almost acyclical at the present time. If you look at some measures of U.S. housing, their affordability is exceptional. You could say in some ways houses in the United States have never been more affordable. But then again, a lot of people are still holding mortgages that are in negative equity situation, and they can't necessarily take advantage of the value that's out there in the rest of the housing market. It's one of those situations that the U.S. housing market is going through a very difficult adjustment. It's still going through an ongoing adjustment, and you almost have to look at other sectors of the economy to drag the housing sector around eventually. Once we start getting solid job creation in the United States, that will then start easing some of the burdens on the housing market. Because right now, if the jobs aren't out there, you're not going to get people moving. You're not going to get people going into cheap housing markets to look for jobs because there just aren't jobs there. Once you get the job creation, we will start seeing housing come back. But again, housing is impaired, and this recovery is certainly going to lag the improvement in the rest of the economy, and certainly is going to lag the improvement in jobs.
Okay, so finally, I guess till the end of summer, what do you kind of expect the trading range on the Canadian dollar to be?
Well, I would say, certainly I think it's going to linger above parity, and I would say probably 103, maybe 107, maybe 108, depending on what happens in the near term with the U.S. I don't really expect it to go much above 105 on a persistent basis, but again, given the downside risks to the U.S., if the U.S. dollar doesn't enter a recovery soon, and we start talking about the Bank of Canada raising interest rates, it could certainly spend a bit of time above 105.
Okay, David, thank you very much for joining us today, and we'll talk to you again soon.
All right, you're welcome.